Hi there, and welcome to the Rhodes Business School Postgraduate Diploma in Enterprise Management. This is the module on entrepreneurial law. Now, you can spend umpteen years learning your law, or you can play it by the book and use lawyers when you need to. However, every entrepreneur has to have some basic legal skills about the entities that they work with. That's what we're going to be concentrating on when we go through this module, to find out what trading in South Africa is all about and what are the basic things that you've got to observe. So here we go in lecture 1, which is to just look at what are the basic trading entities. And before you even get on to discussing what is a company and how do you operate it, you have to look at the South African economy. Now, on the Davis Tax Committee, we developed this little illustration. We said there are the big companies in the formal sector, and they have all the legal resources that they could possibly need. But in the missing middle, we have the entrepreneurs. That's you lot who are attending this lecture. And they have very different requirements to the survivalist businesses in South Africa. Survivalist businesses are extremely simple. They don't have many laws and regulations. We will look at them later in the course. But we have to make the important distinction between what is a survivalist business and what is an entrepreneur. The entrepreneurs are described as being the missing middle in the South African economy. The National Development Plan puts a huge emphasis and expectation on how they can lead us to making a better life for all South Africans. But there are simply not enough of them at the moment. Entrepreneurs should ultimately grow, and their businesses should provide further employment, and they should ultimately land up in the formal sector. Survivalist businesses, on the other hand, have little growth potential. They are making their contribution to South Africa by keeping a few people surviving off their businesses. Collectively, there might be 1 million survivalist businesses in South Africa, where there might only be about 100,000 entrepreneurs. So let's have a look at it and see how we go. Now, when you start off in business, you have to decide what type of legal entity you're going to trade in. So you start off with, why don't I just trade in my own name? Forget having a company, I want the simplicity of being a sole trader. Or I might hook up with a friend and trade as a partnership. Then come some very clever dicks around the place who want to form trusts. We're going to try and exclude them from this conversation as far as possible. And finally, there is the issue of a company. Yes, you can go out and form a company, but there are going to be costs involved and compliance matters that we're going to have to deal with. That's what we've got to go through. Small business has a special concession in the Income Tax Act relating to small business corporations. We'll have to look at them. And then there is a tax package for survivalist business called turnover tax. We're going to have a look at that as well. But let's start off with individuals or sole proprietors and partnerships. What's the beef about them? Well, why would you trade as an individual? Answer, it's damn simple. You don't have to have a license to trade. You just get out there and you start trading. So that's super. There are very few formalities. You just get on with it. You have absolute control in what you are doing, and there is no separation of your personal finances and the finances of your business. And there'll be some tax advantages in it as well, in just staying small and below the radar screen. The disadvantages are that the risk of your business enters your personal life. If you knock up a whole lot of debt in your business, it is not separated from your personal debts and assets, and consequently, if something goes wrong, well, you could lose everything. You have no limited liability if you want to trade in your own name. You also have no continuity. If you die while you are a sole proprietor, there's no management left in your business. So it's very difficult to realize any type of profit or funds when we sell a sole proprietor's business after they die. And you may experience that as a sole trader, you have very limited access to capital. This is because bigger businesses generally want to deal with companies. They get a comfort from this, that the company is properly run and that it will be able to pay its debts. They are not always inclined to favor the sole proprietor. So, we have the 6th schedule of the Income Tax Act, which says if you have turnover of less than 1 million rand per year, there is an extraordinarily generous package which allows you to pay tax based on turnover only. You just have to top that up. You don't have to measure profit and do all those funny financial statements and everything else. Simple twice a year tax return, and that keeps the SARS off your back. Yes, it's very nice if you are a micro business, but when we're talking to entrepreneurs, we're actually saying we're hoping that your turnover is going to go well beyond 1 million. So we're hoping that you're going to do a whole lot better. We'll see more about that when we deal with the income tax component of this module. In partnerships, well, partnerships used to be very popular, and in the profession some still are. We take the profits and we split them up in terms of profit sharing ratio. That can be established either in terms of a partnership agreement, or we can establish that in terms of a verbal agreement. Nice and simple. It does give greater access to funds, but there are disadvantages as well. What we find is in the disadvantages that you become liable for your partner's debts. And we have to look at that and say, is that really what you want? If your partner knocks up debts while you are asleep, you can be jointly and severally liable for them, almost as if you're married. Not a lot of people want to do that. So a lot of people avoid partnerships. There is also the legal implication that when one partner dies, the partnership must cease and re-establish itself. And that can be an expensive, time-consuming affair. Maybe we don't want that. And sometimes they don't give the best tax advantage. Again, we'll look at that under personal tax. So there you have the personal tax tables of South Africa. They look extraordinarily complicated, and it's actually not the entrepreneur's job to be a master of the Tax Act. Actually, we get tax nerds to do that. You've got to know the basic philosophy about what we're talking about. And the way that it goes is this. South Africa's tax system is very generous to those who earn less than 550,000 rands per annum. So, if, for example, you are only earning 100,000 rand per annum out of your business, well then you really don't want to go very much further than being a personal taxpayer. The problem is when tax income for a person exceeds 550,000 rand a year. That's where Prof Godin, the Minister of Finance, has very little sympathy for you, and he's basically going to say, I want my slice of your pie. In fact, I want more from you than if you were trading as a company. So what we see in South Africa is this issue that people over 500,000 rand per annum, there are only about 500,000 of them in South Africa, they pay an extraordinary amount of South Africa's tax, and if you're going to earn that sort of money in running your own business, you just don't want to be on that tax table. That's why you go and look somewhere else. So what we are finding is individual taxpayers have some advantages, unless they go towards the super tax rate. And the super tax rate in South Africa is 41%. If you look in the left-hand column, you'll see that the corporate tax rate is 28%. So you could be paying a whole 12% more by electing to pay tax in your personal name, as opposed to that of a company. But before we all stampede off and say, when in doubt, form a company, which was one of the very popular things that we used to say in tax matters, look at your capital taxes. That's capital gains tax. The top capital gains tax rate for an individual taxpayer in South Africa is just 16.4%. But if you go into a company, it immediately goes up to 22%. You must also take into account that we've got dividend tax on corporate tax distributions, but we don't have dividend tax in individual tax distributions. So it will depend on whether you want to keep your money in your company and grow it, or whether you want to take the profits and spend it, as to the tax rates that you're going to enjoy. Right, so we take that to the next level now, and we find the clever dicks that are forming trusts all over the place. Now this is a bit of a scam in South Africa. There are currently about 300,000 trusts in South Africa. Only about 100,000 of them are submitting tax returns. The Davis Tax Committee, on which I've worked, has looked at this and said there's a lot of tightening up in the arena of trusts that needs to happen. So there's a lot of change that is on the way in this whole thing. So what can we say about trusts? Trusts have a flat rate of tax of 41%. Individuals have a sliding scale up to 41%. Trusts pay 41% from day one, unless they are what are called vested trusts, which distribute their income through to individual taxpayers. Trusts also have a far higher capital gains tax rate than do individuals. This has all been changing over the years. Trusts used to have a super tax advantage, now it's changed. But we don't need to go there for entrepreneurs. Trusts are certainly not the way to go for a small business. There are other mechanisms, particularly under companies, which can help. So we move on now to the final type of trading entity, which is your company. Right, now companies have different tax rates, and there's a special concession for small business corporations. We're going to have to do a whole lecture on small business corporations, how they're taxed. But in general, we get a basic point position on companies that works as follows. Companies have the big advantage that they are separate legal entities. Thus, they enjoy limited liability. So, if your company goes to the wall, you don't go to the wall with it. And everybody places a huge amount of emphasis on that. Please remember that that doesn't apply in certain circumstances. Two important ones to note in this regard. If you have signed guarantees for your company, then you will be on the hook for it. Further, if you are irresponsible in the way that you run a company, you can also be held liable for a company's debts. So that's not a blanket exemption. There is better access to capital when running a company because outsiders can look at your company and see its governance structures, and this gives them comfort that you're running your company properly, it's a well-established business, people are more inclined to lend to a company like that. There is also the question of continuity. Because you've got a separate legal persona, you've got the position that if the shareholder dies, the company carries on the next day. And we don't have to go through closing down a partnership or selling off a business that is involved in a person's estate. That can be advantageous. We have a flat rate of tax in companies of 28%, which is lower than the top rate of tax for individuals at 41%. But remember, you pay that flat rate of tax from Rand 1, not as we do with individuals who only start paying tax from about 80,000 rands a year upwards. The disadvantages are the formalities. Companies have enormous formalities, which we're going to have a look at in various lectures. You're going to have to get into that world of pain of compliance. And those compliance requirements get bigger and bigger. It's absolutely essential that you observe them. If you don't get your compliance right, nobody's going to want to do business with you, and you could actually get prosecuted. So you have all the requirements of the Companies Act and corporate governance staring you down. So this means that we're going to have a whole load of regulations in running our companies. These are going to be expensive and time consuming. But hey, there are advantages in running companies that we mustn't turn away from. And so the big thing to watch out for with a company is that the reward for potentially having a lower tax rate has a cost going with it. And that is that you're going to have to run your company properly in terms of the Companies Act and Tax Acts. Otherwise, you're going to make some very expensive mistakes. So when it comes to companies, there we see the 28% tax rate below the individual's top rate, but we have to note that that's not all. There are other forms of taxation with companies, so that we have dividend tax on its distributions, and we also have a higher CGT rate that has to be factored in at the end of the day. In the old days, the saying was, when in doubt, form a company. Today we've got to say that whole thing needs to be re-evaluated, and we've got to say having a company carries a consequence that we will run it properly. And that's one of the things that we're going to have to learn all about in entrepreneurial law. So that's just the introduction to the type of entities that we're going to be using. We're now going to move on to other factors such as how you run a company, how you tax a company, how you contract with a company. Thank you for enjoying this first lecture with me. I'm Matthew Lester at the Rhodes Business School. Thanks for your attention.